Welcome to Mortgage on My Mind, where we take the mystery out of mortgages and make dreams of home ownership a reality. I'm Natalie Salins, a top 1% mortgage broker with 20 years of experience, based right here in sunny Los Angeles. If you've ever wondered about pre-approvals, appraisals, or what loan product is right for you, don't worry, I've got Mortgage on My Mind, so you don't have to. Each week, I'll bring you expert advice, real-life stories, and insider tips to help you navigate California's competitive real estate market with confidence. Whether you're buying your first home, refinancing, or just curious about how it all works, this podcast is for you. So let's talk mortgages, demystify the process, and make your real estate goals a reality. Ready to get started? Let's dive in. Hey everybody, welcome to Mortgage on My Mind. Today is a special episode because we have another loan officer on, which I'm so excited about. Alejandro Szita is a mortgage broker and founder of Prosperity Lending. He specializes in financing solutions for artists, entrepreneurs, and self-employed professionals, which is very similar to myself. With experience in real estate since 2006, same with me, across residential, commercial, and capital raising roles, he is known for structuring loans with complex income profiles and is a regular guest on Real Estate and Finance podcasts. So welcome. Thank you so much for being on.
Thank you, Natalie. Very pleased to meet you.
Nice to meet you. And where are you located?
In Irvine, Southern California.
Oh, in Irvine. Okay, great. So you get to work with a lot of self-employed people like in the entertainment business as well.
Yes, 99% of our loans last year, almost 100, but we had two that were conventional. So short of 100% of our loans are what they call the non-QM loans for entrepreneurs, business owners, and the borrowers that you mentioned.
For sure. So why don't you tell us a little bit about non-QM loans? I've mentioned them all the time because I as well specialize in them. And Movement Mortgage, which is the company I work for, we have a vast expanse of non-QM loans that we actually underwrite in-house, so we don't have to broker it. So yes, but tell everybody a little bit about what that means.
Okay, I would like to start by the definition of the word non-QM. That always baffles people, and it used to baffle me. Non-QM means non-qualified mortgage, but this is from the perspective of Fannie Mae and Freddie Mac and the conventional loan. It doesn't mean that the loan is not qualified. It doesn't mean that there is something wrong with the loan. It simply means that Fannie Mae and Freddie Mac have called this type of loan non-qualified because it doesn't qualify to their standards. That's what non-QM means. And usually, I'm always laugh because you and I, we have to do training every year. We have to do the continuing education and a bunch of courses. And I always laugh when in the courses, you spend all these hours studying and the last half an hour, the last hour, they go, we're going to talk about something that you may encounter someday called a non-QM loan. And that's all we do.
That's all we do. Totally. I don't do quite as much as you, but I would say 30 or 40% of my business is non-QM. Most of my clients are self-employed and work for the entertainment business, but I structure things super specifically in order to qualify them for conventional. So we work it out most of the time.
You are completely right about that, and I would try to do that too, because if you can structure it as conventional, you save them some money. So we always go for that approach first.
Exactly. But a lot of the time I'm telling people that, like, does it even make sense to structure where you have to pay more taxes just to get a little bit of a better loan? Sometimes that doesn't really make sense.
It does. It's not just the taxes. We find out that very successful people that are very busy, the loan is not their major priority. They need it to get to their objective. So to them, time is more valuable than the savings. I'll give you an example. Right now, we're doing a loan for a very successful entrepreneur. He invented an electrical device. He's an electrician, but years ago, he invented an electrical device. He is very well off, and he could do a conventional loan, but he chose not to do the conventional loan because by doing a bank statement loan, we cut the time, and the amount of things that he needs to provide. So for him, closing 2 weeks earlier has a value, and that value, and also for his peace of mind. I never forget this story. I had a very well qualified, high net worth individuals years ago. I was trying to save him some money. He didn't ask me for that. I got him a conventional loan. His tax return was like 300 pages. I got it done, but it was such a nightmare. This is one of those cases like you got the loan, you got it cheap, you got it inexpensive, but the customer experience was, it consumed so much of his bandwidth that he was almost, yeah, Alejandro, you got me the deal, but I would have rather not gone through all of that.
But also, sometimes people are like, what do we have to do to stay conventional? And can I pay more in order to go like 1 year tax return program and just pay more in taxes this year? And when you actually do the numbers, when you have the conversation with somebody about whether it makes sense or not to do this, to show more income for the 1 year on the tax return so that they can purchase as a standard conventional. And now they owe 70 or 80,000 in taxes, more than what they would. When you think about for a standard non-QM program, the rates are pretty darn similar nowadays. Yes, they are higher, but they're pretty similar. And when you do the numbers, you're like, do you really want to pay 70 or 80,000 more in taxes to save $200 a month? Is that really the sensible thing to do?
You're completely correct, and I would add two more things. Usually, and maybe you have found this to be the case, for self-employed people, we rarely use Fannie Mae, we use Freddie Mac. Same rates, same everything, but Freddie Mac has a little bit more flexibility. And that little bit more flexibility allows you to do the loan conventional. Now, another thing is this. When you look at the tax return and when you talk to the accountants, you can structure a tax return in such a way where the income is there, but you don't have to pay so much. As you and I are not CPAs, we're not supposed to give tax advice or anything, but usually what I do, I ask the customer to speak to his accountant. And then doing that and using a Freddie Mac loan, you can structure it in such a way that maybe you don't need such a big discrepancy in the income.
It's interesting. Freddie Mac does allow for us to take ratios higher. A lot of the time I can pull an LP approval. So for all of you listening out there, the agencies that approve loans are called Freddie and Fannie. They are government agencies. They set guidelines for rates and loans and loan limits and everything. And they also have their own approval systems. So the Freddie Mac approval system is called LP, the Fannie is called DU. And a lot of the times LP will pull an approval better than Fannie. But with self-employed people, if the company has not been established for over 5 years, you have to do 2 years tax returns. And both Fannie and Freddie have their own guideline around this. Freddie is the entity itself. If the corp return, the S corp, is not established for at least 5 years, you have to do a 2-year tax return. Fannie is different. Fannie's more lenient. If the business itself has been established for 5 years, then you can go 1-year tax return. So I tend to do Fannie a lot more actually in this, because if they were a Schedule C borrower that now has a corp and they changed to a corp even 4 years ago, Freddie's going to make me go 2 years, but Fannie's going to let me go 1. So a lot of the time lately I'm using more Fannie because of that, because in that way they are more lenient.
You're correct. We're lucky that most of our borrowers have been in business for over 5 years, but you're correct.
Yes.
If you were in business for less, what you're saying is like a very good tip.
It's a big part of it, of knowing how to structure the file. And I have to argue with underwriters all the time because they're like, no, the business. And I'm like, no, it's a very specific guideline as long as the business itself has been established, not just the entity of the corp. So it can get tricky sometimes, but that's why it's important, you guys, for us loan officers to know our guidelines for sure. So, yes, so tell me, you were telling me when we first got on what you think is the most important thing for our listeners to understand about lending.
Yes.
Why don't you go into that a little bit for us?
And you say your audience is mostly loan officers, right?
Or buyers. I think the audience is a lot of first-time home buyers, a lot of people that are coming on to hear about mortgages and what the market is like.
Okay. So for first-time home buyers, I'm going to give you what I consider to be something that I learned over the years. The first thing I would do if I was a first-time home buyer, I would go and look, I would go in Zillow and see the type of property that I want to buy. I would go to a few open houses first. Then I would talk to a loan officer, not the other way around. I have found out through my clients that when
That's
you
so
start,
interesting. That's normally opposite, right?
yeah, it's
Go
normally
ahead.
opposite, but it never
Yeah.
works. It never works. You know why? Because decisions and mortgages go with the attitude and the energy that you put into it. And I'm going to tell you very quickly because I know we don't have a lot of time.
Okay.
But this is the ultimate example that for me nails it. I've seen this over 20 years, but this is the ultimate example. High net worth individual, millions of dollars in the bank. With one check, he could buy the house. He says, Alejandro gets me a loan. He doesn't get it. The loan goes south. Lady in her 60s, working not a very high paying job for 60 years, always dreamed to have a house. Rejected by everyone. We did go conventional, by the way, on that one. She gets it. So it's not the money, it's your energy. So in order to spike that energy, I always said to the borrowers, they said, okay, Alejandro, I was referred to you. What do you need? I said, I need nothing. Just tell me what you want. They tell me what they want. I don't ask them for a single piece of paper, not even run their credit. And I say, okay, I'm going to give you homework. Go and look in Zillow and go to a couple of open houses and then send me what you would like to buy. Once you have that, then we'll talk about the numbers. So that would be my advice to people that want to buy a home.
Interesting.
My
Okay.
advice to loan officers would be, don't go into the game of pricing yourself to the bottom. Don't go into the game, oh, I talked to Joe Blow and he said he could do it for this. Can you do it for that kind of customer? In my opinion, you should ditch it right away. Because obviously you need to deliver a good rate and obviously you need to deliver good terms. But if the customer is shopping you to the penny, that's not something you want to do business with. Doing a loan requires a lot of commitment, requires a lot of hours. Not only that, you could go through all the trouble. You could get a person to clear to close. Then he goes with another lender. That ruins your reputation with that lender. I had to learn that the hard way. So ditch all those people that want you, because another thing, just a mathematical thing that I'm going to give you right now. I've been in this industry for 20 years and I've seen it all. I worked in commercial, in residential, raising money for funds. I worked in a $1.2 billion hedge fund in Beverly Hills. This is what I've seen. In order to be viable, you need to make a minimum of 2%. I'm going to say that again. You need to make a minimum of 2% of every loan. Now, some loans you'll make 1.5. Some loans you'll make 2.25. If you consistently work for 1 or 1.2 or 1.5, it's just a matter of time you'll be out of business. Because the stress, the amount of work that you need to do, and the type of client that you're attracting will, instead of make you expand, they will work towards you succumbing. So that would be my advice to loan officer. I know that's a tough advice. It's a tough advice.
That's a tough. It's also different because it depends what type of brokerage you work for, right?
Yes.
So I'm in an IMB, which it pays us very differently than what you're talking about.
Okay.
Nobody's making that much money here.
Okay.
Because it's just a totally different structure. We don't run our own P&Ls.
Okay.
But I understand what you're talking about. My branch and such needs to make that much on a loan.
Yes.
But me
Correct.
as an individual loan officer, I don't make that much on the loans. But I understand what you're saying because you don't sell yourself short. You know what kind of service you offer and you know how much you're worth, right?
Yes.
And it does feel like sometimes we are having to manage a lot how much we're worth because a lot of people don't have the respect that they realize it takes when it comes to us working for people and how hard we work, you know.
Yeah, and then you'll see we're entering a year that is very volatile. You saw this at least I saw that on the second semester or the last quarter of last year. People were fighting to the teeth. I had a customer which I did a loan for him that nobody else could do, and now he's in a position to go conventional. And I like him and I love him, but he was trying to shove me to death. And I said, you know what? Find someone that can do the loan for that. And I could see, because he found someone who could do it for almost nothing, I could see how much that person worked over Christmas for almost nothing. And I was thinking to myself, wow, this is just a race to the bottom. So don't be that guy. That would be my advice to a loan officer.
Tough, but yes, I get that for sure, for sure. It's a hard thing to manage and understand how far you can be pushed and not pushed when it comes to people shopping. And it happens every day, of course, on every single file. It's just is what it is. But it's definitely something that has to be managed.
Yes.
We'll say that.
Yes.
We'll say that for sure. Yeah. So tell me, since you do such a huge percentage of non-QM loans, what's your favorite non-QM product?
The problem is that investors that run the secondary market have had to actually scale. In order to do what they do, they have to scale. In order to scale, they have to come up with formulas. In order to come up with formulas, they have to have a very narrow focus. So that's why in the non-QM world, lenders and investors, when I say investors, the ones that work on the secondary market, they are document driven, like bank statement loan, profit and loss, assets only, debt service coverage ratio. By doing that, they can scale, but by doing that, they don't service, in my opinion, the self-employed person. So when you say, which is my favorite product, I don't like any of them. The only one that I really like is the debt service coverage ratio, because that is borrowed from the commercial world. And the residential application is very light in comparison to the commercial world, because a DSCR commercial is like light years away, even though it's the same fundamentals as a residential DSCR. But that would be to answer your question. So that's why what we're doing, we're creating a fund, a private fund. We call it the soft money. It's not hard money, which caters and has a product that is designed only for the self-employed person. I know that we don't have time to go over that thing right now, but that is my favorite product, the one that we're custom making for the self-employed borrower. Other than that is the DSCR.
Interesting. And we can talk about what DSCR is another time, but when you say soft money, so is it a no-doc loan?
No. Imagine yourself, you're back in the 1950s or the 1940s. People don't know, I was born in Chile, and in Chile it was like that. You would go and sit to somebody in the bank who already knew you. You've been banking with him for a while. He knew your deposits, he knew what you did for a living, he knew your face. You would tell him what you needed, the money that you needed and why. Based on what you said and based on what he saw, he would grant you a loan right away, and he had a holistic approach. He didn't just look at your tax returns or your bank statements or the this or the that like they do today. He looked at the whole picture. So any loan that we do, even if it's a bank statement, profit and loss, or assets only, or DSCR, we always first look at the whole picture. That's why when we have a borrower, we never ask him for anything. We listen for an hour or half an hour just to see if the story makes sense, just to see if what they want to do makes any sense. And based on that, based on the holistic approach, we go to a documentation program. So the program that we're creating is not FICO based, because FICO doesn't measure. People think that FICO measures success. FICO is a guideline invented that measures who are the most profitable customers for the lender. Because the self-employed person, just to give you an idea, I know that we don't have time to go into this, but
sure,
a self-employed borrower views credit completely different than an employee. If a self-employed borrower gets, let's say, a $10,000 credit card, he's going to use it to the max. He's going to do what he has to do, and then he's going to pay it off. He's thinking about paying things off. He's not thinking about debt management, which is what the FICO really measures. He's not thinking, if I have a $10,000 credit card, I can only use 1,000, because to get the highest credit score, you cannot use more than 10% of your credit limit. But that's an artificial arbitrary that was created some years ago that is completely not applicable to a self-employed or an entrepreneur. An entrepreneur is going to use it to the hilt, then he's going to pay it off. But he's being penalized. I never forget the case of a high net worth individual who had 40 paid mortgages. 40 paid mortgages. His score, not even, he was in the high sixes. I could not believe it. So
yeah, but there has to be a reason for that. You're in the high sixes because I'm a credit guru. That's what I'm like. I study credit reports. I love it. I love looking at how things are analyzed and stuff. And if you're in the high sixes and you have a bunch of closed mortgages, there has to be a reason why you're in the high sixes because credit rates how well you pay debt. That's all it does. And you're right. A lot of the time, it doesn't make sense. I have people all the time that come to me that are like, have 30 credit cards, have never paid any of them late, but 4 of them are brand new. So the credit's going to be a little bit lower. And when you look at it, you're like, why are you in the high sixes, low sevens right now when you've never paid anything late? You have no collections, nothing. And you can figure out why. But certainly, in my opinion, I don't like if you're in the high sixes, it means you did something wrong. It means that something happened because if you've paid all those mortgages on time and have never made a late and they're closed, if you just wait 3 to 6 months, of course, when you close a new file, the credit score goes down a little because it's a file that's just been closed and the bureaus are worried that something happens that you're closing accounts down, right? But you give it like a little bit of wait period and the score goes right back up after you close an account. So the high sixes, it means something else happened, honestly. It means that there's a collection or
not
accounts are really at high balances.
Not necessarily. Have you ever heard of this guy called Philip Tyrone? Philip Tyrone?
No.
I stumbled on this by accident. This is a loan officer in the year 2000. He created this 6 CD binder. He called it the 7 Steps to 720.
Oh, okay.
This doesn't exist anymore. You can get it on eBay for 20 or 30 bucks. So I have mine. And in this binder, when you listen to these 6 CDs, they're like 40 minutes each. So you can do it in your car. They're really simple. Then you see how the FICO system is really built and what it really measures. Now, if you go online, he has this online now, but in my opinion, it's not as good as these 6 CDs. So if you have a chance to really buy it on eBay, get it. And here, if you listen to these CDs, not that what you said is wrong, what you said is right, but I've never found a better explanation of how the credit system works than on those CDs.
Yeah.
And just very quickly, just to let you know, I had a buyer, I worked for him for 2 years. He's a self-employed entrepreneur, nothing wrong, but he was at 660, 680, there was absolutely nothing wrong with it. It took quite a while to get it to 700, we did it, but that's what I found out. Basically, the credit score just measures debt management. And usually successful self-employed people don't think that way.
I agree. Like I have clients that are self-employed that rack up $30, $40, $50, $60,000 a month on a credit card and they pay it off every single month. And somebody who's doing that, depending on the time of the month that we're pulling that credit, if they're at 60, the credit is not going to be as good. Their credit score is going to vary vastly throughout the month, depending on the time, but they pay it off every single month. So most of the time, as long as they have enough credit history and things like that, then the score is okay. I always tell people, FICO rates how well you pay debt. That's all it does. That's what it does. It rates and gives us a score on how well you manage and pay debt.
And how little you use it, because once you are a millionaire, once you've made it, this is what I see that very successful people do. Then they don't start using the credit as much. They only use a fraction. But that's once you made it. What happens when you are like in the making? Now they're going to change the credit score. They're going to use possibly the Vantage score, and they're going to take into account the longer picture. So this could be beneficial for some people.
Interesting. I thank you. We don't have more time. I wish we did, but thank you so much for being on. It was a great conversation. I appreciate your time, truly. I hope everybody enjoyed it out there. You can find Alejandro, I'm looking on all the socials and everything, and we'll have his information, of course, in the below. And thank you so much for being here and chatting with us today.
Thank you, Natalie. Very pleased to meet you, and the best of luck to you.
Same. Appreciate it.
Thanks for listening to Mortgage on My Mind. If you're ready to start your mortgage journey or have any questions, I'd love to help. With 20 years of experience, I make the process as simple and stress-free as possible. Check the show notes for my contact info, and don't forget to subscribe, leave a review, and share this podcast. Until next time, I'm Natalie Salins, here to help make your real estate dreams a reality.